The reason you're busy but still broke, it's not because you're not working hard enough. It's actually because you're looking at too many things at once, and trading is no different. Honestly, it wasn't until I learned long-short equity strategies that I was able to normalize my returns and make them consistent. So in today's video, I'm gonna give you the latest long-short equity strategy, A to Z, and how we're putting it on in a way that you can take action right after watching this video. So that being said, let's get into it and I'll see you on the screen. All right, so as always, this October idea for long short equity is gonna get started with a little bit of housekeeping as far as our latest long short equity on long LSTR, short CNI. We made a whole video about it about 2 videos ago, and it's always in our newsletter as well on our Twitter channel. So feel free to go check that out. But this trade, we entered at the 72 on the spread. It got up to 82 and change, and it's now back down to 74.5 due to the Trump tweet on Friday about Chinese tariffs going back to 100%. Still, we are at between 3 and 10% returns on this trade, and our exit is still set for 100 to 105 on the spread. So a little bit more to go as far as upside there. Now, let's get into the idea that we're gonna put on this week. As always, we're gonna start with the industry view as far as the price action and what the market is trying to tell us. This idea is going to be in the home building, real estate, construction, and all the laterals that are included in that industry. So anything like wood, electrical, HVAC, and all those other industries that are exposed to the cyclicality of real estate. As you can see, the XHB ETF, which covers home builders, is now trading at 15% off the 52-week highs, which is essentially correction territory. So the market here is telling us something, and that something is definitely bearish. So our job right now is to figure out whether the market is right in making this call and whether we can spot any industries or any companies that we can ride as far as taking a position and profit from that view being proven right in the coming quarters. So as always, let's get on with some leading indicators as far as the industry goes. And for this one, I picked the building permits. A few newsletters ago, we told you that building permits were at risk of coming into a long-term balance and crossing it. We're already there. As you can see, the purple line suggests that the long-term balance has been crossed, which means that building permits are now crossing into a depressive state. And it makes sense. When you look at other data points, just like house listings over the past year, we're up 50% roughly. So there's really no need for these home builders to start building out more homes, especially when the average home price is now $512,000 and mortgage rates are still above 6%. So I don't think there's any rush to get building, and therefore I think the market is taking a bearish view on the whole space due to these factors going online. Now it's time to check whether we're early, on time, or late to this whole party, and we can do so by spreading the industry drivers and spot some outliers as well. So we can spread out the whole sector. When it comes to building, we see that building products, home builders specifically, are trading at a discount when it comes to forward PEs. These are at 16.9 compared to the industry average of 20.8. Now, this can be justified because the home builders industry is looking to grow at only 5% for the next 12 months. So those earnings are barely keeping up with inflation, despite the home prices going higher, despite the cost of building homes going higher, justifying those higher prices. I don't think there's any pricing power, any margin support for these businesses. So therefore, I can see why the 5% is there. I can see why the discount is there. This is essentially an area where I would want to focus my shorts on. But now, in case that we're wrong in the whole cyclicality of real estate, I do want to go long something and therefore be hedged and market neutral. We can see an outlier in the wood products industry when it comes to forward EPS growth. So for the next 12 months, they're expecting to grow by 77%. The biggest delta as far as the building products sector goes. So this, of course, is compared to the 21%, pretty high. And then we have a premium on the forward PEs of 26.9 compared to the 20.8 average. I think that is justified because of the above average growth that they're looking to deliver over the next 12 months. Now, we have to figure out why these are the expectations, right? As far as wood goes, we have tariffs, we have inflation, we have a slowdown in housing. So why is the market willing to overpay for wood? And that is our homework that we have to get on to right now. So now we know where we want to go short, as I said, and how we can hedge in case we're wrong. But here's a little sweetener for you to further diversify this idea and mitigate the potential volatility that you might see in your portfolio. So when you look at this REIT, this real estate investment trust called Equity Residential, stock symbol EQR, it is trading pretty low compared to 52-week highs. And here's something I like about it. It's holding properties at around a 6 to 7% cap rate. So for those of you that are not into real estate, that means it's essentially undervalued properties in the residential sector. Now, the stock also pays a 4.5% dividend yield, which is another proxy for cap rates. So I think this is a great way to diversify that tariff situation, that inflation situation, and housing slowdown. This REIT residential in space, I think it's going to be a great outperformer in the coming months, especially as you are now exposed to undervalued property. So now let's go back to the whole wood example and why the market is looking to overpay. When we spread out some of the companies in that space, we have Weyerhaeuser, stock symbol WY, trading at a premium. So we see the forward PE of 45.2 times compared to the average of 26.4. Now that premium is there because they're looking to grow at 178.9% over the next 12 months. So this is likely the one company driving that above average growth rate in the overall wood products industry, next to West Fraser, which we already did a pitch on it a couple months ago. And also you have the PEG ratio. So the forward PEG ratio of 0.3 suggests that 70% of that EPS growth is not priced into today's quoted price. So, I mean, there's a lot of upside there. I think that we can justify picking this stock as a potential long. Now for our shorts, I did see Johnson Controls International, and we can see that it does trade at a discount of 24.2, roughly right below the average of 26.4, and that is justified because of the 18.1% growth for the forward EPS compared to the 76.9% average, right? So now we can see that the PEG ratio is at 1.3 times, which means that this future growth, which is below average, it's 30% overpriced. So that gives us a direct line to this being a potential short idea. Now that's as far as the quantitatives go as picking the stocks. We're gonna cover some of the qualitative data in just a minute, but here's something that I wanted to mention as well for WY. The consensus price target out of Wall Street analysts suggests a 40% upside in this stock as well. Now, when we line up the trade here, we can look at the spread that is right now trading down to the second standard deviation on the downside. That is essentially where we always want to enter a long short equity trade, as long as we have some justification behind it as far as mean reversion, correlations, and another reasoning behind it founded in fundamentals for us to take this trade long. So let's cover that. But right before we do that, this trade can be taken at the $17 level, and our exit ideally would be at the $27 one. That's roughly 58% returns targeted for over a quarter. So there you can see the beauty of how long short equity works and how it can make your money compound for you. Now, for those statisticians out there, you're gonna get this right away. If not, don't worry, I'll go over it in just a second. We have a 0.03 p-value giving us a 95% confidence interval that this spread will convert back to the mean. Essentially, this is a test over the time series, testing how many times it crosses the mean right after deviating by a lot as it is today in the second standard deviation. That test gives us a confidence interval of whether when we deviate, it's going to come back to the mean with a certain degree of confidence. And right now we have 95% confidence, meaning this trade is looking pretty good on the technical side. Now, when we look at correlations, the correlations between these two stocks are on a low level cyclically, right? So that means we are now going on an upswing driven by the fundamentals that we see right now, such as tariffs, such as the slowdown in housing and others that we'll cover shortly. So that upswing can also mean that the two, which are trading further apart now, have to converge, driving the spread back to the mean. So now we have a couple of quantitative points giving us credit to taking this spread long. Now, when we hone into a Z-score, which is a more detailed version of our spread, we can see exactly where we are as far as deviations. And we just passed the second standard deviation on the low, as I mentioned. Last time this happened on the upside, you can see that it lasted for about 20 to 30 days. And this is right about there. We've been trading below this standard deviation for about a month. And this is just ready to go right now to start deviating or converging back to the mean, I should say. So after that, we can look into some of the qualitative issues as far as the business models go and some of the catalysts that we can expect down the line for this trade to convert back to the mean. And this is where we can spread some of the comparables and see where the financials are at right now. I'm not going to bore you with all the ratios here, honestly, because it would take too long. And second, because none of these seemed as important when it comes to outliers, except for capacity and where analysts see the stocks going. So capacity shows us that Weyerhaeuser is oversubscribed. It's trading at 2.3 times its capacity, while Johnson Controls trades at only 1.9 times, which means that one business is oversubscribed. It's essentially going to see higher demand, higher pricing power, and essentially margin expansion, while the other one sees just the opposite. And given where the future growth is, where the businesses are at today, I think that justifies Wall Street analysts calling for 37% upside on Weyerhaeuser and then 4% upside only on Johnson Controls as a consensus, right? So, I mean, we can take analyst views with a grain of salt. They always talk to each other and they have a reputation and career to protect. So they're not always going to be 100% honest with you. But I think this is pretty much accretive to what we're saying here today. So here's some other points that I want you to keep in mind for Weyerhaeuser and Johnson Controls. Weyerhaeuser is exposed to domestic U.S. wood production, where tariffs can begin to support local prices and boost the company's pricing power, margins, and EPS, which explains the forecast that we see in the stock, making it an outlier and calling for a premium. Now, when we look at JCI, this business relies heavily on CapEx, so capital expenditures for government infrastructure projects, which are likely to be delayed or outright canceled given the shutdown that we have right now. Some people expect it will last around 25 to 35 days, which is enough to get all of these projects in the back burner, if not canceled, like I said. So apart from that, JCI also has heavy exposure to China, therefore putting it on the way of further tariffs. And we just saw last Friday with Trump tweeting an additional 100% tariffs on China. I think this is pretty much the reason why the market expects lower EPS growth from this company and calling for a discount on its forward EPS. Now, when we spread this trade in a Thinkorswim platform or any of your brokerage platforms that you prefer, you could see that we're right there at the 17 line, and I've highlighted the 24 to 27 roughly. That's the area where I want to exit. That orange shaded line or area is essentially my initial exit, where I would consider taking off partial profits or reviewing the whole tariff situation, where the housing market is going and where it's at that precise moment, and figuring whether I should write the whole position, take partial profits, and write the other partial up to my 27 target, if not higher. So again, this chart has to be made with the hedge ratio, and it's something that you see right here on the top, right? So you have WY minus that long number with a bunch of decimals. That is the hedge ratio. And the hedge ratio is essentially what keeps you quantitatively uncorrelated to the S&P 500. It halves the volatility of your portfolio moving forward and gives you all the benefits of this strategy. If you've never been exposed to long short equity, we have a free 5-day email crash course that you can sign up for today. Link is below the video. And by day 3, trust me, you're going to be ahead of 90% of retail traders coming up with ideas like this one, using zero charts, zero chart analysis, just top down overlaid with a quantitative bottom up analysis. Now, whenever you finish that and figure, okay, this is something that I need moving forward, otherwise I have no chance of winning this game, we also have the flagship program, the Sovereign Trader, to offer to you. You can apply also in the link below. we'll have an interview, just you and I, for about an hour and a half. So make sure you have time for it. And then we'll decide whether you are a fit for us and we're a fit for you. And we can move forward with some offers as far as coaching goes, mentoring, and get you inside our investor marketplace. That being said, good luck with this trade. Make sure you sign up to our newsletter. We're going to be covering a lot more detail about this moving forward. Make sure you follow us on Twitter. We're always posting our ideas live. And we also have a WhatsApp deal room where our members got this trade last week, and some of them already put them on and should be in profit as soon as next week. That being said, thank you for being here. I hope you got a lot of value out of this. You learned a lot with me. It's been an absolute pleasure, and I'll see you in the next one.